In this video, we are going to go through cash value collateral loans. Really on the topic of how policy loans work, this is a great alternative to be aware of if I'm considering borrowing from a policy, but I'm just having a hard time doing it because I'm looking at the interest rate saying, it's 5 to 6% and I can get a loan elsewhere at 3%. And the loan elsewhere for business might be tax deductible. Like, why would I take a loan at such a high interest rate? And I want to use the money in the policy because it's producing, but I just have this wall there. And if we feel like that, this is a good option to be aware of. The more awareness we have, the better decisions we can make. So, collateralized line of credit. What it is, a cash value collateral loan. So it entails taking a cash value life insurance policy to a lender, typically a bank, and saying, hey, I've got this $100,000 in cash value. And I can take a loan directly from the policy and pay 5% interest to the insurance company. But that 5% is high. So instead, I'm going to go to the bank and say, bank, I'd like to assign, let's call it $100,000 of my cash value. Some banks let you go up to 100%. Most are right around 90 to 95%. But let's assume for the sake of this example, I'd like a $100,000 loan and I want to post my cash value as collateral. How banks view this is often as loaning against cash. Most banks and lenders are very familiar with cash value life insurance. Most of them own it, so they see it continue to appreciate over time, but they're familiar with it and know that it is a guaranteed asset that continues to appreciate over time. So the bank says, all right, we will give you a $100,000 loan. Let's call it a line of credit. That's usually what it is. Different banks and lenders have different terms. Typically, I see a 5-year line of credit given. Interest-only payments are usually required when I've got that line outstanding. Every 5 years it can be renewed, but the interest rate may fall between 3 and 3.5%. We have seen some lower than 3%, but I will add that that is dependent on the size of the loan. The larger the loan, the more attractive that interest rate becomes. If I'm north of $1 million, as far as a collateralized loan, some banks you could definitely see below 3%. Depends on the size of that transaction. The higher the loan, the more profitable it is for them. That's really what they're looking at there. So 3 to 3.5%. Now, what's the drawback to this word? Here has been the number one reason why some people do not do it. Control. If I have a loan outstanding with a bank, I am liable to what? Pay interest only every month. The bank can call it. With this, they typically don't, but they can call it. And if they do call it, I've got to pay it back. Now the advantage is there is if I have to pay it back, how can I pay it back? I can literally just borrow from the cash value of my life insurance policy to pay it off that way. It is posted as collateral, so I cannot borrow from the life insurance policy while that loan or while that collateral assignment is outstanding from the lender or from the bank. They've got to sign off on it first to make sure the collateral still exists. So I'm at their terms. Now, when I take a loan, the application process with most lenders is often quite smooth. There's often an initial credit check, a hard check where they do pull credit the first time around, but they do not require, in most cases, W-2s, tax returns. It's not like trying to take a loan against a piece of property. I don't have to deal with all of that stuff. They're typically very smooth transactions. And then each year, upon renewal, it's a soft credit check. Very, very easy though. Most people's experiences have been very, very smooth and pleasant with established lenders. Some that are still trying to find themselves are working through the issues, and we've seen some lenders dissatisfactory, but again, they're working on themselves to get better. So going back to this, I take cash value of $100,000. I go to the bank and say, I'd like to assign this $100,000 as collateral to you, the bank, and can I have a $100,000 loan? Bank says, sure. we're going to give you a line of credit at 3 to 3.5%. You're liable to pay interest only, and then you can pay it back at your discretion because it is a line of credit. Let's look at the numbers. So where this comes into play is if I am looking at a life insurance policy, I'm looking to take out loans, I'm going to pay what to the insurance company? 5 to 6%, while I continue to earn dividends and interest on my entire cash value. What we're going to look at here is a policy with an individual paying in a substantial amount of money. So this is based on an actual case study, 58-year-old individual, $500,000 per year for a period of 5 years, $2.5 million going into the policy, and he does want to use $2 million of that for real estate and some other things he has going on. Now, on this example, as you look at the numbers, his plan is to borrow out and then pay it back, but specifically he's crunching the numbers and looking at the total cost of interest. This is important to people, especially with large amounts of money. It's important to me. He doesn't want to hear, hey, it's not about rates of return or interest. Don't worry about that. Just trust the process. He's like, no, I'm putting $2.5 million into this policy. I want to maximize my returns, pay the least amount of interest, and earn the most amount of interest, most amount of money possible. So here we go. $2.5 million going into the policy. And he didn't say that, but it's often how I feel. So $2.5 million going into the policy, $2 million coming out in policy loans. So annual loans each year, $500,000. While he's taking that loan, he is paying the interest. So here's his loan balance. When he takes a policy loan, what do you notice on the far right about the death benefit? So when I borrow from a life insurance policy, the company says to you and I'm still going to pay you dividends and interest on your entire cash value. Any money in cash and what's outstanding in loans. I'm still going to pay dividends. However, whatever you have outstanding in loans, you are liable to, or you are going to have an interest charge. There's a cost to borrow, and we're going to collateralize your death benefit. So the death benefit reduces dollar for dollar. Next year, I take out another $500,000 loan, reduces dollar for dollar, and you'll see this continue to reduce while I am taking out policy loans. Now, here, we're going to begin to repay it, or I should say, first we're going to pay interest only. So here's the loan interest. The interest rate on this policy is 5.66%. Interest due year one, $28,000 and change. He pays $28,000 and change. Through year 5, there's my payments. Year 6, 7, 8, and 9, he begins paying back $500,000 per year toward the principal. There's the loan interest, and there's the loan interest payments. So on the right here, we've got his net interest payments. Here's the total amount of interest he paid to the insurance company. Cash value, $240,000. I should actually look at year 9 here, about $3 million. Now, the next example, well, let me just back up for a second. If he doesn't borrow from the policy, especially if it's non-direct recognition, what happens? Whether I borrow and pay back or don't do anything at all, I've still got that $3 million here. So that's going to accrue at the same rate of growth no matter what happens. Next example. Instead of borrowing from the policy, he looks at a cash value collateral loan. The interest rate is not 5.66%, 3.25%. I'll add here, we've got other case studies with this example. The net IRR is right around 4% in this example. That's the net tax-free internal rate of return as time passes. So 3.25%, that's his interest rate. Okay. $500,000 per year. Those interest rates typically are variable. Make sure I want to hit on that. Takes out the $2 million. Cost to borrow each year is much less. Policy is still going to continue to earn the exact same rate. That's going to grow at the same pace regardless. So he's got if you had a high yield bank account just earning interest over time, and you're leveraging that bank account with a lender to borrow at 3.25%, that's what we see going on. in some ways. So, interest payments, paying it back, then begin to repay the $500,000 per year. Here's really what I want to touch on. Net interest payments are what? Not $452,000, $260,000. And his cash value is fully repaid. He pays that loan off. He no longer has the collateral assignment on his policy, so he can use it however he wants. Point here is this is a means he could leverage his policy while he has his money in a safe, liquid, tax-free area, accruing at that 4% over time, and instead of borrowing at a point in time where it hurts him, just from an interest perspective, that's how he looked at it, he's doing so in a favorable environment, saying, all right, I can leverage it. I'm comfortable making interest-only payments and dealing with the bank, no problem at all. So in this case, it worked out quite nicely for him. And again, we've got other videos and more content on cash value collateral loans, but we did want to hit on this in respect to policy loans because it is something very, very valuable to be aware of. It's not, we don't want to take the stance to say, hey, there's one way to do this with policy loans every single time. You're earning a greater dividend than what the loan rate is. We got to look at the net internal rate of return. The numbers are so important to see. This way we don't have buyer's remorse or think that I've got a positive spread, whereas in reality I don't. That's where people often get upset. And we don't want to do that. So I hope this one helped. I hope this entire series helped. I had a lot of fun putting it together. If you have questions or would like to see different case studies or receive more information, reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.